The biggest crash in 40 years? I'm your host, Steve Van Metre, and thanks for joining me today. And global elites are panicking as major economies are failing. Let's over to Wall Street Journal, where we picked today's story up with a headline that Eurozone inflation rate rises to 10.7% as recession looms. And before we get into this story, I want you to understand that when there's periods of high inflation, here we can look at the US CPI, that it is usually followed by a recession. Now, there is one case here in the early 1950s where inflation shot up and came down fast enough that there was a recession, but notably the recession happened later. But if we look here and see that usually periods following rapid moves of inflation are usually met by a recession. And you see even periods where it just percolates higher and finally until the recession hits. And now we see this big move higher, and many people say, nah, that's not going to have a recession. But history shows that the reason we have it is wages don't keep up with inflation. So what do you think? I know many in the comments say inflation is going to go higher, it's going to stay elevated, and a lot of people disagree. I say it's going to go lower, but what do you think? Is this going to cause a recession, at least in the US? Well, I'm going to make the case why over in Europe and other parts of the world, it will. The broad measure of consumer prices has risen sharply since Russia's invasion of Ukraine. By mid-September, Russia had cut off its supplies of gas to 80% of their year earlier total. And now Europe has had to look elsewhere for gas supplies and paid much higher prices. This is a key issue here. While storage levels are now high and gas prices on the world markets have fallen from their peaks, household energy bills lag behind those moves and are much higher than a year earlier, as are food prices. So just to understand what's going on in Europe, they ran out of gas, so the governments went around the world and bought up all the supplies and paid peak prices for them, filled up all the storage tanks, and now what's happening is, of course, demand for gas is plummeting. In some parts of the US now, it's back at near zero, and all of a sudden you look at Europe, and any of this gas that gets used has to be borne at these higher prices. They can't just say, hey, you know what, we didn't want to pay those higher prices, we now want to use these lower prices. And this is what you get when governments intervene in the free economy. Not sure what you think about that, but for European consumers, while the rest of the world is going to pay lower gas prices, they're going to pay higher prices until that inventory is drained. The European Union Statistics Agency Monday said the consumer prices were a whopping 10.7% higher in October than a year earlier, the fastest rate of increase since records began in 1997, 2 years before the euro was launched. But get this, however, national records go back even further, and Germany's measure of inflation was the highest since December of 1951. But not to be outdone, Italy's annual rate of inflation jumped to 12.8% in October from 9.4% in September, while Germany's inflation rate rose to 11.6% from 10.9%. By contrast, Spain, it actually went down to 7.3%. And so what is the issue? When you see these periods of higher inflation, it's not that just wages don't keep up with it, and that is a huge factor. But what that means is as inflation moves quicker than people can afford it, they have to make changes in their spending. And that's why we see recessions following this, because it eats into their discretionary spending budget, and then that percolates out into the broad economy. And next thing you know, you're facing a recession. The outlook for inflation depends on the availability of gas supplies through winter months and average temperatures, as well as government measures to protect households from hardships, as many Eurozone governments have introduced price caps that directly limit inflation, but still, they're not low enough. High energy prices have been a headwind for the Eurozone economy this year because they leave households with less to spend on goods and services, exactly what I've been saying, that are produced inside the currency area, while raising costs for businesses, particularly energy-intensive factories. And as you can see, as we look around the world, when consumers or businesses are looking, where they're going to buy product from, you can see that the Eurozone is going to face higher prices for a while until this inventory of gas is used up. And that means the world's going to look elsewhere, and it's going to be really difficult, I think, for the Eurozone to come out of this at all without at least a recession, and again, possibly even a depression. With energy use set to rise as cold weather spreads across the currency area, most economists expect its economy to contract in the final 3 months of the year and the early months of next year, which I completely agree is likely. The ECB will update its forecast in December, and if like any central bank, will probably be wrong and end up tightening. But it's not just the Eurozone that's facing problems, it's China's factory slowdown worse than expected under the weight of COVID policies. So we start to look at this as a global synchronized economy. What happens in one part of the world affects other parts of the world. So if Eurozone is slowing down and demand there is going to slow down, well, where should we look next to see demand falling? Well, we'd look to China, the world's biggest exporter, and sure enough, we see signs of problems. The official Purchasing Managers Index for manufacturing fell to 49.2 from 50.1 in September. The result fell short of the 49.7 median forecast. Keep in mind, a reading below 50 indicates a contraction in activities. Now, mind you, at 49.2 is not a very big contraction. What we're really looking for is when these start to get down to 45. But what it's telling us is the pendulum of the economy is slowing. We talk about these expansions, the pendulum rises, and then it reaches that apex and it starts to slow. That's what we're seeing now. And then all of a sudden, out of nowhere, we should start to see in the months to come, these Purchasing Managers Index start to swing the other direction, showing us and validating the global economy is indeed contracting. The official non-manufacturing PMI, which includes services and construction, also slipped into contraction, now going further down to 48.7 from 50.6 in September. The October gauge for services alone fell to 47, and now we're starting to get near that danger zone of 45. That was the lowest level since April, when a months-long lockdown hit China's commercial capital and manufacturing hub in Shanghai. And China's growth showed sharply over the past year, dragged down by a deepening real estate slump and sluggish consumer spending. We've been talking about the housing market there, but get this, the new home sales at the country's 100 largest property developers fell a whopping 28.4% in October, and that is huge because that was normally a real busy month for them. And remember, we talked about the issue with the banks there who have these loans out on unfinished property. What do you need? You need people to go out and borrow money, buy properties, so the actual builders can get the capital, which they don't have, to finish the properties. So people will actually start paying on their loans again because they don't want to, because now they're realizing their property may never get done. And of course, we've talked about this puts the banking system in huge jeopardy there. But look at what's going on with the broad economy, because it's all going to follow lower. As China's COVID restrictions continue, economists fear there'll be a permanent scarring effect as more manufacturers and services lay off workers and slash wages, and slashing wages is not what you need to keep up with rising consumer prices. The employment subindex for October's manufacturing PMI slipped to a 5-month low of 48.3, meaning companies are starting to lay off in China, and that's not a good sign because they're unlikely to count on exports, which is a key driver of their export-driven economy, right? We look at the U.S. and what do we see here? Demand starting to slow down, demand starting to fall, and of course, we're the biggest importer in the world. That means it's going to have a direct impact on the biggest exporter in the world, and we should see layoffs starting there, and exactly what's happening. A subindex of the manufacturing PMI that measures new orders fell to 48.1, the lowest level in 6 months, as export growth slowed to 5.7% year over year. So this is becoming bigger than an issue of COVID zero policy. It's becoming an issue of a slowing global economy. Looking at this company here, Shuang Electron Instrument Company, which mainly exports thermometers to the U.S. and Europe, cut its workforce to 380 from more than 500 last year. And get this, as sales collapse, new orders slump more than 40% this year from a year earlier. And as, of course, the general manager notes, we've never seen such a big drop in orders in the past 40 years. Now, well, of course, what this means for the U.S. is we can still have a melt up in stocks. We can still have this bullish narrative. It will take months for this data to come across the pond and start to show up here. And what we're seeing already signs, the biggest collapse in 40 years is coming eventually to America. But will this put the Fed on pause? Well, probably not. Morgan Stanley's Wilson says the end of the Fed tightening is nearing, but not just yet, as we look to Wednesday to see another big hike. Indicators including the inversion of the yield curve between the 10-year and 3-month treasuries, a recession indicator with perfect record, all support a Fed pivot sooner than later. Therefore, this week's Fed meeting is critical for the rally to continue, pause, or end completely. What he's saying here is the Fed is likely to still increase 75 basis points, but as long as they make any indication that perhaps December's hike may be actually reduced or a pause, watch the markets rally, because what Mike Wilson is saying is this indicator has got a perfect track record and he's spot on. Here you can see the 10-year Treasury minus 3-month Treasury yield. This data provided by the St. Louis Federal Reserve FRED database, and notably inversions follow or lead a recession. You can see inversion, then following a recession, inversion, recession, inversion, recession. Here we are, inversion again. And so this will put all eyes on the U.S. Central Bank, which is widely expected to raise rates by 75 basis points. U.S. stocks have rallied over the past 2 weeks as traders parsed economic indicators for signs of impact of Fed tightening, even as big tech earnings disappointed. But the Morgan Strategy strategists expect S&P 500 to rally to 4150, or about a 6% gain from Friday's close, and then call for an end of the bear market in the first quarter of next year. But is that likely? Well, let's take the same chart that Mike Wilson referenced and overlay the market, because I think this is one he's got it wrong. And here we can note when the curve steepens, when interest rates fall, when we see 10-year yields and 3-month Treasury yields fall, it usually indicates that the worst for the market is not over. You see this yield curve steepening, the market goes down here. We're looking at the Wilshire 5000 or total U.S. stock market in red. You see yield curve rising, market going down, yield curve rising, market goes back down, and next yield curve will rise, suggesting the market is more likely to go down. But that doesn't mean we can't have a big bear market rally here at all, because the market will actually like if interest rates start to fall, because it'll hit the tech sector in a big way. As rate squeeze punishes once triumphant tech stocks, we note the 2022 market bust has turned the popular FANG trade into buying the Facebook, Meta, Apple, Amazon, Netflix, and Google. And that has been the leaders. But of those 5 companies, now Apple, only down 12% this year, has outpaced the NASDAQ's 29% decline. And why does 29% matter, my friends? Well, simple, because the typical bear market, somewhere around 30 to 35%. This is what's giving people all the reason to believe that the bottom is in. And there was rampant speculation in the sector, as we know that with rising rates, people come back to their senses and realize we need to be more circumspect. And then all they're saying here is what happens is tech stocks don't like rising interest rates. So you imagine now you have all this bearish, bullish narrative going into the end of the year. You have U.S. investors thinking the stock market is going to make new highs. Interest rates start to come down as the Fed starts acting squeamish on Wednesday. Next thing you know, you've got a big catalyst for a big boom in tech. And even though Europe and China may be headed to recession, you could see one last rally for the U.S. markets before reality hits our shores. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.